10-year note yields continue to creep higher. Going back to those less than dovish minutes we got last week, it seems to me that the market has now taken back a lot of the, whether it was fear, whether it was uncertainty, or whether it was going to be a flight to quality bid to the market. It got what it needed. It flushed out a lot of the shorts, and now we're seeing a slow, steady creep back up into the old range. Remember that 260 to 280 range that we saw in 10-year note yields for much of 2019. We're now right at the bottom of that range, threatening to actually push back up into it. And as we do so, the market just seems to have accelerated since those minutes we got. This is kind of the level we were trading when March FOMC took yields down to the lows of the year. And then obviously we've seen a slow and steady creep back higher, things accelerating here since those minutes, and that nudging us up to the bottom of that range. If we do trade back into the 260 to 280 range, likewise, we'll probably find a magnet taking us closer to 270. So maybe some downside in price, upside in yield here if we can get back above 260 yield. And if you look at market volatility, oddly enough, as we trade back towards the range, we're not seeing volatility bid. As we were making new lows in yield, yes, we saw vols bid. So volatility right now, as it is pretty much across many asset classes, is non-existent. We're seeing it basically hover near the lows, not seeing any fear of any big movement away from expectations. And I think that will probably continue, especially if we get back into the old range and get comfortable again, somewhere between 260 and 270. When we start to see yields get down to those lows, south of 240, 235, yeah, things get a little bit dicey, especially when you've got a lot of short positions on, which we'll talk about in a sec. But I think ultimately the move back into the old range is very comforting to the market. We're seeing that in volatility. Obviously, it's very low, not on the year-to-date lows like we saw probably about a week ago, but certainly close enough that we could touch it at any moment. So volatility low, yields going back towards the old range, taking us back towards expectations. And if we look at positioning, we saw the leverage fund community, which was very short 10-year note yields, really turn in reverse after March FOMC. Actually, a little before March FOMC, actually, they started to cover those shorts, but really that accelerated as March FOMC came and went. And likewise, as we came into those minutes, it seemed to me they were topping out. So right now, they're still net short, just not as much as they were before. And if we go back into the old range, I think they'll start to add again to some of those shorts that maybe had covered. And that is likely why we're seeing yields creep up slowly here at this point and starting to move a little quicker, is the idea that, yeah, the Fed's on hold, but they're not going to be cutting rates this year. At least a lot of expectations are now leaning to that direction. Likewise, the data in the U.S. isn't as bad as it was. And ultimately, the stock market, which could really be a thorn in the side of the Fed here as it goes higher, despite the fact that yields were going lower, as sort of as a tit-to-tat trade, it looks to me like the stock market may find some levity here if earnings aren't great, and that'll trade us sideways, which will give bonds a perfect opportunity to creep back into the old range and kind of trade those narrow ranges, get those shorts reset, looking for a move back towards 275 or 280, although I don't think it gets there in the short term. I think that's pretty much the target right now, is to get back in the middle of that old range and then reassess once the Fed meets mid-year after we get through another one of Powell's semi-annual testimonies, to kind of look towards the second half of 2019. First half of 2019 has really been all about international Brexit. It's been about U.S. economy. It's been about the Fed. I think the second half of the year, we're going to start to see how is all this going to unfold. Expectations aside, what is the reality? And the reality is the Fed's probably on hold, but not likely to cut anytime soon. And I think that the U.S. economy isn't quite as bad as maybe it was painted to be, and that will keep things steady as she goes, which means yields at around 240 seem too low, but around 270, 275, that might be just the Goldilocks just right area that we need to be trading in, and that's sort of where we're heading at this point. So right now, the bond market's still uncertain, but if we get those 10-year note yields back north of 260, look for a trade at 270 very quickly, back to the middle of that old range.